Hello and welcome to Fund Screener. Our aim is to provide the most comprehensive fund and ETF research on YouTube, specifically for UK investors. In today's video, we will be looking at investing in Chinese domestic equity using ETFs. Investing in Chinese equity as a UK retail investor is complex and can be confusing. Our hope is that this video should help in clearing up some points of potential confusion, and at the end of the video, we will reveal our top picks for investors looking to target this market in 2021. As a reminder, all the research we went into putting this video together and more is available in the show notes, which you can download from the link in the description. If you enjoy this video and like what we're doing, please remember to hit the like button and subscribe for more videos just like this. This is not financial advice. There are multiple different potential share classes for equity issued by Chinese companies, depending on where shares are listed and who is allowed to own them. This video will look specifically at A shares, which until recently were difficult for most foreign investors to access. A shares are shares in domestic Chinese companies traded in Shanghai and Shenzhen, denominated in renminbi, the Chinese currency. Although the Chinese government has allowed certain approved investors to purchase A shares since 2002, various restrictions and quotas were in place. It was not until 2020 that efforts to remove quotas for participants of the renminbi qualified institutional investor scheme became effective. With the opening of Chinese capital markets and some impressive performance, many investors are now asking how they can get a slice of the A-share market. As of February 2021, the A-share market is constituted by more than 3,500 companies. It is both very large and very liquid, second only to the US in terms of market cap and traded volume. For many investors, the A-share market now looks too large to ignore. Historically, most institutional investors have focused their investment on H shares, shares in large Chinese companies traded on the Hong Kong Exchange in Hong Kong dollars. The H shares market, as represented by the FTSE China 50 and tracked by popular ETFs such as FXC, is skewed towards communication services and financials. Beyond the H share market, A shares offer the opportunity for investors to gain meaningful exposure to consumer staples, tech, and industrials, which are well positioned to benefit from the Chinese growth story and associated key trends. As of the date of recording, the 12th of February 2021, RQFI, an ETF tracking the CSI 300, an index representing the largest 300 domestic companies in China, returned 50.05% year to date. Over the past 7 years, that same ETF, RQFI, represented here in purple, has significantly outperformed a broad China ETF, HMCH in orange, and FXC in blue, a China large cap ETF tracking large H shares traded in Hong Kong. The green line skimming the bottom of the chart is EIMI, the largest emerging markets ETF on the London Stock Exchange. The A-share market is more susceptible to domestic trends than offshore Chinese equity, which by contrast has proved more sensitive to the geopolitical issues presented in the past 5 years. As such, A-shares can offer a significant diversification benefit, boasting low correlation with global equity. The correlation table shows the correlation of the MSCI A-share index in respect to various MSCI global equity indices. Correlation with North American, European, and Pacific equity is low at 0.36 and 0.35. Notably, even correlation with offshore Chinese equity, as represented by the MSCI China X A-share index, is still low at 0.60. The following trends present key drivers for A-share growth: consumerism, urbanization, innovation, and automation. The rise of China's consumption in absolute terms has far outstripped other major economies. Rising relative affluence has increased the depth of China's middle class and its spending power. McKinsey analysis estimates that discretionary and semi-necessary spending will continue to grow at a rate greater than necessary expenditure. A good story for physical retailers and e-commerce. Rates of urbanization have remained behind the developed world. However, 142 million are expected to move to major urban centres by 2030, and there remains significant scope for increased rates of urbanisation. China has and will continue to cement its position as a global innovator. No longer a workshop for cheap, disposable consumer goods, China overtook the US as the single largest filer of international patent applications in 2019, filing 58,990 patent applications in that year. Meanwhile, Chinese universities have conferred the greatest number of bachelor's degrees in science and engineering subjects in the period 2000 to 2014. And, whilst the US still leads as the world's largest single country producer of doctoral degrees, China has significantly narrowed the gap in this same period. Although the Chinese economy suffered from the pandemic, it benefited greatly from being first in and first out, and its unique ability to execute decisive policies to control the spread of the virus. It is possible that average citizens' experience of the pandemic may well accelerate trends towards urbanization and a structural shift from offline to online. Since 2018, MSCI and FTSE have been introducing A-shares into their emerging market indices. Inclusion is a staggered process and, at present, is partial. Currently, A-shares constitute around 5.3% of MSCI's index and around 5.5% of FTSE's. For reference, full inclusion would boost China's single country allocation to above 50% of both indices, with A-shares constituting a significant portion of this. At present, domestic retail investors account for over 50% of the traded volume on the Shanghai and Shenzhen exchanges. This is extremely unusual. However, increased inclusion of A-shares into EM indices is likely to drive significant institutional flow, which has been increasing in recent years. The chart shows the breakdown of A-share investors. The red line running across the columns is the total percentage of institutional investors. A-share ownership for ETF investors present unique and specific risks, the principal of which are state ownership and state-owned enterprises, government intervention, and volatility. State ownership is widespread in the A-share market. The initial privatization of Chinese companies followed a dual market model, with tradable A-shares released to the public, whilst LP shares, with far more extensive rights, were retained by state and local government. Although the exact definition of state-owned is hard to pin down, around 60% of companies in the CSI 800, a broad A-share market index, have a degree of state ownership, and 79 of these companies are majority owned by the state. There is legitimate concern about a misalignment of shareholder and government interest, and potential for capital misallocation and disappointing investment returns. However, evidence would suggest that whilst SOEs have different performance characteristics, they should not necessarily be avoided. The risks of SOEs are typically priced in. SOEs tend to be larger cap companies and exhibit lower valuations. The largest SOEs are concentrated in financials, industrials, and the energy sector, and in some respects constitute a value play at the right price. Curiously, however, research has identified that SOEs also exhibit lesser volatility and greater price momentum. As the below chart shows, state ownership is not necessarily a handbrake on growth. In 2016, 2017, and until September of 2018, companies which were 20% or more owned by the state outperformed those with lower state ownership stakes. There remains a constant low likelihood possibility of government intervention. However, the policy drift has been a continued and concerted effort towards opening, so such a policy reversal seems very unlikely. The China A-share market has exhibited greater volatility than developed markets and the broader MSCI China index, which incorporates a reduced allocation to A-shares alongside offshore Chinese equity. The scatter plot looks at the risk and return characteristics of various ETFs tracking different equity indices. Annualized volatility is on the x-axis and 3-year performance is on the y-axis. Point A is VUSA, a popular S&P 500 ETF. B is a popular developed world equity tracker. E tracks the MSCI Far East ex Japan index, and F plots EIMI, the largest EM ETF on the London Stock Exchange. Point C, of interest to us here, is RQFI, a CSI 300 ETF, and D is HMCH, an ETF indexed to the broader MSCI China index, including offshore Chinese shares and a reduced A-share allocation. The chart shows that whilst A-shares outperform the broader MSCI China and MSCI Far East ex-Japan indices, they do incur greater volatility. The China A-shares market is represented by the following indices. For UK investors, the indices of most relevance are the CSI 300 and the MSCI China A index. However, there are some important differences between the two. The MSCI China A index includes more companies than the CSI 300 and is designed to be tracked by foreign investors. As such, MSCI considers foreign ownership limits and only includes companies whose stock can be traded through Stock Connect. By contrast, the CSI 300 is designed as a representative index for domestic investors and makes no such consideration in construction. As a result, the sector composition of the MSCI China A index differs noticeably from the CSI 300. The MSCI China A index has a reduced allocation in financials and increases allocations in consumer staples, IT, and healthcare. These sectors may be better positioned to benefit from the key trends discussed earlier in the video. A look at the past 18-month performance suggests the implications of this different index methodology may be borne out in future. Over the past 18 months, KBA, an ETF which fully replicates the MSCI China A index, has outperformed RQFI, a fully replicated CSI 300 tracker, by 49.42%. The greater returns of the MSCI index may also be driven by its greater mid-cap exposure. If we compare the CSI 300 to the CSI 500 over a 13-year period from 2005 to 2018, whilst they moved together, CSI 500, an index of smaller companies, outperformed. Note also, however, the greater volatility of these smaller companies. It is argued that the MSCI A index will have better capture of any premium from index inclusion, as it adds stocks as per the inclusion. However, evidence from developed markets suggests that any index addition premium is greatest prior to addition, not after. So you may wish to do your own research here. The range of ETFs available to UK investors with specific targeted exposure to China A shares is limited at present, and even more so once we screen for appropriate size, cost and availability. Some exposure can be gained through EM ETFs such as EIMI or VFEM. We've discussed these in our previous video, but their current inclusion of A shares is not fully reflective of their fully included weight. The same is true of the broader China ETFs such as HMCH, where A shares are currently represented at about 20% of their market cap. For many investors, they may see buying a dedicated A share ETF as their best option. For those wishing to track the CSI 300, ticker symbol RQFI, the X-Trackers Harvest CSI 300 ETF provides a large and readily available, fully physically replicated means to track the index. The fund is far larger than other A-share ETFs, at $820 million in assets under management. It is not cheap, however, charging 0.65%. As investor flows increase to A-share products, we can hope that the price of this and similar products will come down. For those wishing to track the MSCI A index, the CraneShares MSCI China A-share ETF is a good choice. The fund size is currently small, at around $44.5 million, which would normally be a point for concern. However, CraneShares are a specialist China and emerging market ETF provider with larger funds by assets under management in the US. The success of CraneShares in the US and potential future similar success here in the UK means investors may have faith that the product will remain available to UK investors until the fund size grows sufficiently large. The high retail participation in the China A-share market and a number of indicators of potential pricing inefficiency have led believers in active management to claim that the A-share market presents significant opportunities to generate alpha. The range of options offering targeted exposure for retail investors is still rather limited, however. Looking at an active A-share fund is a potential future video if there is sufficient interest, so do let us know in the comments. The CraneShares CSI China Internet ETF, ticker symbol KWEB, has enjoyed stellar performance and is justifiably popular. However, it primarily tracks the performance of offshore shares in large tech companies, so a comparison to an A-share ETF is neither reasonable nor particularly valuable. Again, we could do a review specifically on this ETF, and if that is something you would like to see, then let us know in the comments below. Not all of these ETFs will be available to purchase on all platforms, so your choice might be further limited. At the date of recording, the 12th of February 2021, availability is as on screen. Thank you for watching. We hope you found the information contained useful. If you enjoyed it, please consider liking and subscribe for future videos. Just a reminder, all this information and more is available in the show notes, which you can download from the link in the description. These are completely free to download, however there is the option to make a donation if you wish. Any amount which you might be able to offer would be greatly appreciated. Otherwise, please do not worry. Thank you and good luck with your investing.